Hello, this is Bob Steele. In this lecture, we will talk about Chapter 9, Accounts Receivable. So, a receivable is an amount due from another party. Generally, why do we have a receivable? Because we made a sale on account for the most part, and therefore the individual owes us money. The client owes us money for work and or something that they received in the past. So, the graph shows recent dollar amounts for receivables and their percent of total assets for well-known companies. And you can see, of course, that there's a big difference in terms of receivables in relation to total assets depending on the type of company that we are talking about. A company must also maintain a separate account for each customer that tracks how much that customer purchases, has already paid, and still owes. Why do we want to track that? Because we need to know who owes us money so that we can then collect on it. So when we record the accounts receivable, remember that we're going to record it into another account, which in a prior chapter was called a subsidiary ledger, which will track that amount by person, by customer in that case. So every account that we record, every time we record something to receivable, we know that it's going to be reflected in the general ledger, just like every type of account, by date. But we also need to know that information by who owes us the money. So sales on credit. On July 1st, TechCom had a credit sale of $950. So if we had a sale of $950, the transaction would be we didn't get cash. We got the second best thing. We got an asset of receivable. We got an IOU. Assets have a debit balance. We made it go up by doing the same thing, which in this case would be another debit. And we would credit sales, sales being revenue. The revenue has a credit balance. In order to make it go up, we're going to do the same thing to it, which in this case would be another credit. Now, if we sold inventory, once again, we would have to decrease inventory and record cost of goods sold. We are concentrating on the receivable side in this case. On the second piece of this, we have comp store and collection of $720 from RDA Electronics from the prior credit sales. So this is a sale that we made in the past, and now we're receiving the money on account. We're receiving the money for the sale that we made in the past. That means that we're receiving cash. Cash is an asset. We're going to make it go up by doing the same thing, which in this case would be a debit. And we're going to decrease the receivable. Receivables are an asset, and we need to make it go down if RDA hadn't then paid us, so we're going to credit the receivable. Now, if we take a look at this in relation to the GL, we can see that the GL is in order by date here. So GL is in order by date, and of course this is increasing the GL here because we debited the receivable, increasing the balance from 300, and it's a debit doing the same thing to it, bringing it up 3950. And then it's going to go down by this amount by date. So that's good information that we can see the activity and what is happening by date, but we also want to know that activity by customer or client in this case. And so here's RDA, which owed us $1,000. They paid us $720. They now owe us $280. We need to take collection action or track that process by individual, by customer. And here's the $2,000 owed by the comp store. We have an increase for the sale of $950, and they now owe us $2,950. If we were going to record this on one quick ledger and someone was to ask us who owes us money, and then we can just have this list, schedule of accounts receivable, these individuals owe us money, this amount should then total out to the trial balance in the balance sheet. So advantages of credit card sales. So if we then allow credit card sales, customers' credit is evaluated by the credit card company. So in essence, the risk of extending credit for transactions to a credit card user. So that could be the benefit in that the credit card takes some of the risk out of the credit sales. The sales increase by providing purchase options to the customers. So obviously if we collect credit cards, one of the major things that we're looking for is to increase sales through the use of the credit card, and cash collections are quicker oftentimes through credit card than through a receivable that we would collect in 30 days. Now, if we were to record the credit card, of course, the downside is that the credit card charges us, say, a 4% fee in this case. So on July 15th, TechCom has $100 credit card sales with a 4% fee, and its cash and its 96 cash is received immediately on deposit. So what would the sale look like if we sold something on credit then? If we automatically got the cash, then we're getting cash of the 96. And of course, that's the 96 after the 4%. We can calculate that two ways, by the way, and it's good to see the calculations. If we were to calculate the 100 times 0.04, we of course come out to $4. And if we take the 100 minus the 4, we get the 96 that we are going to receive. So note that if we are not going to receive 4%, then we are going to receive the 1 minus 0.04 or 96%. So we can also take 96, if we move the decimal 2 places over, 96% times the 100, and that would be 2 ways to calculate that $96 there. So cash is going to go up by the 96. We're going to credit sales for the entire sales price because the customer paid 100, and then the difference would have to go to the credit card expense, the expense of us using the credit card in this particular sale. So installment sales accounts receivable, amounts owed by customers from credit sales for which payments is required in periodic installments over an extended time period. The customer is usually charged interest. So if we have a longer type of installment sale, such as we're purchasing a large item, such as an automobile, then of course it would be very likely that we would then charge interest in the installments of the receivable over a longer period of time.